Trump's threats to annex Greenland and his seeming lack of support for the Western world order, including NATO, have sent shockwaves through the political and financial systems. Like an earthquake, you might have felt the shaking, but you still haven't seen the cracks in your house structure or seen the tsunami about to hit you. Global financial decisions about where to invest are careful calculations balancing risk and reward. And the ultimate currencies, if you want to attract foreign capital, are credibility and trust. The US has the highest public debt in the world. It's exceeding $36 trillion, roughly 120% of GDP. The weight on the US economy is staggering. To give just one example, the USA now spends more on interest payments than on military spending per year. Still, markets generally consider US Treasury bonds to be one of the safest investments in the world. But recent events hint that this might be a thing of the past, and the ramifications might be catastrophic for the US economy. I'm Stephen Lekander Højlund, a PhD in political science. In this video, we are going to take a look at how some European pension funds started to offload their US state bonds and what would happen if Europe at large decided to offload too. It matters far more than Treasury Secretary Scott Bessent wants you to believe. Trust me on that. Let's take a look at what actually happened. On a Wednesday in early 2025, Akademikerpension, a Danish pension fund managing $24 billion for academics, announced something unprecedented. They would sell their entire $100 million holding in US Treasury bonds by February 1st, 26. The reason? Weak US public finances. Anders Schelte, their chief investment officer, was very clear. US Treasuries were historically used for liquidity and risk management, but they are being replaced with US dollars and short-duration debt. Now here is where this is getting very interesting. Anders Schelte specifically said this wasn't political retaliation against President Trump's threats to acquire Greenland, a Danish territory, but he added that the ongoing US-European tensions did not make the decision more difficult. And we can probably read between the lines here. The very next day, Alecta, a major Swedish pension fund, confirmed they already sold the majority of their US Treasury holdings, between $7.7 and $8.8 billion. Their reason for doing so? Decreased predictability of US policy, massive budget deficits, and growing national debt. So what does this really tell us? This isn't just one fund making an isolated decision. This is already starting to become a pattern. After all, remember that Chinese funds also offloaded quite a bit earlier on. So let's zoom out and look at what other European funds are doing. PFA Pension, Denmark's largest with $129 billion in assets, reduced its US Treasuries in 2025. They increased currency hedging because of what they call US unilateral trade policies and Trump's challenges to the Federal Reserve. Sampension, managing $44 billion, also a Danish pension fund, is taking a wait-and-see approach so far. But I wouldn't be surprised if they follow suit, because they have openly stated that the current uncertainty doesn't support US investments. Now here's a fact that might surprise you. Danish investors held only $9.88 billion in US Treasuries as of November 25. That's a tiny fraction of the $9.3 trillion in foreign-owned US debt. But, and this is crucial, 26% of Denmark's massive $782 billion pension assets are invested in the US. That's up from just 16% in 2018. So while Treasury Secretary Bessent dismissed the Danish sell-off as irrelevant, calling Denmark's holdings under $100 million, he's deliberately ignoring the sort of bigger picture. European investors collectively hold approximately $8 trillion in US bonds and equities. That's about 21% of US public debt. That's nearly double what the rest of the world holds combined, according to Deutsche Bank research. So what happens if this becomes a large-scale trend? Let me break down the economic consequences for the United States on the macro level. First, borrowing costs goes up. Here's how it works. When investors sell US Treasury bonds, the supply of the bonds increases and demand decreases. This in turn pushes the yields higher, which means that the interest rate the US government pays on its debt increases as well. The US already has a national debt exceeding $36 trillion. Even a small increase in borrowing costs translates to tens of billions of dollars in additional annual interest payments. Second, confidence can also erode over time. US Treasuries are considered the world's safest asset. When major institutional investors start selling because they view US public finances as weak, it sends a signal to the markets worldwide. Remember, Moody's already downgraded the US credit rating from AAA to AA1, citing rising debt and Trump trade policy uncertainty. That's just one sign of it. Third, the dollar will be weakened. When foreign investors sell US bonds, they often convert those dollars into other currencies. Large-scale selling creates downward pressure on the dollar, making imports more expensive for Americans and potentially fueling inflation. Essentially, everything will be more expensive for US citizens, and that's on top of the existing tariffs imposed earlier, which haven't really kicked in yet. But here's the curiosity question. If it's so bad for the US, why would European funds risk their own returns by selling? The answer reveals something fundamental about what's happening. European pension funds aren't acting irrationally. They're making a cold calculation. Anders Schelde from Akademikerpension said they are replacing US Treasuries without impacting returns. They're basically just moving to US dollars and short duration debt instead. More importantly, they're keeping about 60% of their equity exposed in US stocks. Because while they're worried about US government debt, they still recognize that American companies deliver returns. US growth is mainly driven by the Magnificent Seven and the belief in the AI revolution. If we look at the S&P 493, without the Magnificent Seven, the US stock market has only delivered very modest results. Anders Schelde's prediction is that more capital will shift to European independence efforts. One example is that Akademikerpension recently invested in a European defense fund. This represents capital that would have previously flowed to the United States, but now flows to Europe. What we are witnessing isn't just a financial decision, it's a geopolitical shift that takes place because of the actions of the US president. Europe is responding to what a lecturer called decreased predictability of US policy. They are responding to Trump's terrorist threats, 10% on 8 major NATO partners starting in February, rising to 25% in June. Of course, that was all taken off the table, but it's the uncertainty that was on display. It's the variability and the randomness of which Trump is acting. Remember, risk management is all about being able to, with predictability, to chart a course and see where the world is by tomorrow. They are also responding to the uncertainties produced by Trump's threats to Greenland and the Kingdom of Denmark's sovereignty. They're responding to Trump's lawsuit against Jerome Powell and the US administration's attempt to erode financial institutions in the US. Essentially, the markets are reacting to the fact that we are seeing a pattern of unreliability that is really having a negative impact on the risk assessment of the United States. The risk premium is basically going up with every single crazy thing that Trump says. But now let's talk about what keeps US Treasury officials up at night. The real danger isn't Denmark selling $100 million worth of bonds. Scott Besson was totally right to call that amount totally irrelevant.
And what I am urging everyone here to do is sit back, take a deep breath, and let the things play out. As I said on April 2nd, the worst thing countries can do is escalate against the United States.
The real danger is contagion. If major European funds managing trillions collectively decide that US fiscal policy is too unpredictable, we could see a coordinated sell-off away from US Treasury bonds. Japan, for one example, holds over $1 trillion in US Treasuries. China holds hundreds of billions despite reducing its position in recent years. The UK also holds substantial amounts. If European funds lead the way in treating US Treasuries as riskier assets, other foreign holders may follow. But that's not the only thing. The more bonds investors dump on the market, the more unstable the US economy becomes. The risk curve is exponential, and selling off all bonds at once might not even be possible if there are no buyers. This is the analogy of the silent cracks in your house foundation, as global investors won't advertise their sell-off, thereby risking destabilizing the global economy at large. If the US economy is severely destabilized and go into recession or even worse, it could really have very bad effects also on the European economy. But it's not only European pension funds that are acting. The IMF has also slashed US GDP growth forecast due to geopolitical tensions and tariffs. So as you can see, the risk calculations are very difficult to make. But everyone knows that this rally around AI probably will have an end soon. If there are massive sell-offs of US Treasury bonds, the interest rates goes up, and the borrowing costs for risky, not yet profitable tech companies will also go up. We have seen that before, and the result is that tech stocks, they plummet. Meanwhile, the US growth is almost exclusively happening in the Magnificent Seven companies. In many ways, it does look like the US economy is a very fragile house of cards at the moment. Or to put it differently, there are multiple fires going on, and Trump is desperately trying to hold it down, pouring sometimes gasoline on one fire and water on another. But frankly, the US economy has had these problems for many years, so it's not only on Trump. The real difference, however, from back then and now is that we have a US president who is rocking the boat and introducing a lot more uncertainty by just being present and in almost every statement that he is making. One example of this is that Trump will elect a new chair of the Federal Reserve in May this year. This person will most likely be more prone to lower the interest rate as Trump wants, because he knows that the US cannot afford higher interest rates due to the high debt. But that will increase inflation and put downward pressure on the dollar as it becomes less attractive. So the case could very much be that Trump is trying to solve one problem by actually making another one. So where does this leave us right now? We are entering a period where US financial dominance faces a credibility test. For decades, the assumption was simple: US Treasuries are safe, the dollar is king, and American markets are where serious money goes. The assumption is being questioned at the moment. And frankly, I was quite surprised to see that it took so long for it to be questioned. The US economy by no means is abandoned, because the rewards are very high in the US stock market, but the risk of investing and buying treasury bonds has just increased a lot. The United States needs to take this very seriously. When sophisticated institutional investors managing billions cite weak public finances and decreased policy predictability, that's not political posturing. They don't have any skin in that game. That's just cold risk management. If the US continues down a path of ballooning deficits, unpredictable trade policies, and geopolitical threats against allies, we'll see more capital flows redirected. Not all at once, of course, not in a dramatic crash kind of way, but it will gradually, persistently reduce America's ability to borrow cheaply and finance its operations. However, ultimately, the cracks in the walls might issue a crash-like situation where everyone will run for the doors and try to avoid being the last one inside. Like a bank run, it can go very fast if large, credible financial institutions dump assets fast into the market. The Danish and Swedish pension fund decisions are very small in dollar terms, but they're enormous in symbolic weight. And we have to remember that China was actually the first one to start the sell-off. The Scandinavian sell-offs represent a message from European allies. We are watching, we are concerned, and we think your offer is about to get too risky. You could also ask yourself the question, would you trust Trump with your pension savings if he was just an ordinary broker down at Wall Street? Well, my answer to that question is definitely a no. If you found this analysis valuable, please subscribe to stay informed about global economic shifts and the effect on all of us. And share this video with everyone who needs to understand what's really happening behind the headlines about US, Europe, Greenland, and Denmark. I'm not only talking about Greenland, I'm mainly talking about Denmark, so I'm not covering every single news story out there. But if Greenlandic and Danish news are something for you, stay tuned and keep on watching. Thank you.